We're diving straight into a 50-year-old financial system that literally controls everything, from global energy prices right down to government policies. There's this hidden engine running the world. And no, it's actually not the banking system, and it's definitely not the stock market. It's the petrodollar. For over half a century, it's been quietly shaping our reality, and today we're going to unpack exactly how the whole shebang works.
Geopolitics is, well, notoriously complex, right? So we're going to use some straightforward note-taking methods to revise the ultimate macroeconomic exam topic, the petrodollar. We really need simple methods to review this stuff fast. We're stripping away all that overwhelming jargon to give you the ultimate cheat sheet for mastering global finance.
So here's our structured study guide to quickly and impartially break down exactly how this geopolitical engine runs. Number 1. Taking better geopolitical notes. Number 2. From gold to fiat. 3. The petrodollar deal. 4. The recycling loop. And finally, number 5. The de-dollarization challenge.
Let's kick things off with Section 1, Taking Better Geopolitical Notes.
You simply can't understand the petrodollar without first establishing the fundamental baseline of the entire global economy, which is our massive reliance on oil. Our modern world depends on it for almost everything. It isn't just about fueling our cars, planes, and ships. We literally need it to manufacture plastics. In a lot of countries, it's heavily used to produce electricity. We even rely on it to create fertilizers and everyday chemicals. Because oil is just that essential, it creates this massive global market where countries like Saudi Arabia pump out a huge amount of it, and nations like Japan eagerly consume it, even though they barely produce a drop themselves.
Moving right along to Section 2, From Gold to Fiat.
The absolutely crucial point here is figuring out exactly how the US dollar came to completely control this massive, indispensable oil market. How did one single currency take over? Well, let's look at the timeline. At the end of World War II, the U.S. emerged with its economy largely intact. That led to the 1944 Bretton Woods Agreement, where the dollar became the center of the global financial system backed directly by physical gold. But then, fast forward to 1971, President Nixon decoupled the U.S. economy from the gold standard in what's known as the Nixon shock. Just 2 years after that, in 1973, the OPEC oil crisis hit. Arab oil-producing countries stopped selling oil to nations supporting Israel in the Yom Kippur War. That caused oil prices to absolutely quadruple, leading to massive shortages and some seriously severe inflation.
Now, that 1971 Nixon shock we just mentioned, that fully transitioned the world into a fiat currency economy. So, fiat currency gets its value purely from public trust, not from a physical commodity like gold. You might be wondering, why didn't the US dollar just collapse when it lost its gold backing? Honestly, it's simply because the US economy was massive, the government was viewed as stable, and a huge chunk of global transactions were already being done in dollars anyway. It essentially grandfathered its way into being the world's reserve currency.
That brings us to Section 3, the petrodollar deal.
That massive 1973 OPEC oil crisis we talked about forced a radical new economic model. The U.S. orchestrated this brilliantly simple yet incredibly powerful bilateral agreement to counter those quadrupled oil prices. Basically, the United States agreed to provide military protection and support to Saudi Arabia. In return, Saudi Arabia agreed to sell its oil exclusively in U.S. dollars. And because Saudi Arabia was the absolute heavyweight of the oil producers, the other major players soon had no choice but to follow suit.
It all boils down to this simple, inescapable logic. If every country needs oil, and oil is sold in dollars, then every country needs dollars. Imagine you're a country like Japan again. You need oil to survive, which means you absolutely must get your hands on US dollars, keep dollar reserves at the ready, and trade with the US or hold US assets. It's the foundation of the petrodollar system, forcing nations worldwide to constantly acquire and hold US dollars just to keep their lights on.
Let's jump into Section 4, the recycling loop.
So where exactly does all that money go? Think about the billions of dollars piling up in oil-producing nations. They don't just sit on giant vaults of physical cash. They invest it. Countries buy oil with dollars, the producers earn those dollars, and crucially, they invest them straight back into U.S. government bonds, American companies, real estate, and global markets. The dollars flow right back into the U.S. financial system. This creates a highly effective, self-perpetuating cycle known as petrodollar recycling, keeping the U.S. dollar exceptionally strong.
This constant recycling engine grants the U.S. some immense structural and financial advantages. Because everyone constantly needs dollars, the global demand never really drops.
That allows the US government to borrow money way easier and at significantly lower interest rates than other nations. On top of that, because so many international transactions are forced through US banks, it gives the United States a unique ability to use financial sanctions to exert massive international influence.
Which takes us to our final part, Section 5, the dedollarization challenge.
Fast forward to today, and nations around the globe are actively looking for ways to bypass this 50-year-old setup. Countries like Russia, Venezuela, India, Pakistan, and China are attempting to de-dollarize. This is a massive goal of the BRICS trade alliance, which is actively trying to reduce global dependence on the dollar by trading oil in other currencies like the euro or the Chinese yuan. But here's the catch. Walking away from a deeply entrenched financial system is far from simple. In fact, many countries that are openly hostile to the US still trade in dollars. Why is that?
The answer really lies in the network effect. Think of it kind of like social media. On one side, you have Twitter, representing the US dollar. It has deep, high liquidity, meaning you can move billions without crashing the market. It's got massive existing contracts, established hedging systems, and incredibly strong legal protections. On the other side, you have an alternative, let's say Facebook's Threads. Just like it's incredibly difficult to force everyone to suddenly switch social media apps when all the conversation's already happening on Twitter, changing global currencies risks disrupting entire insurance and pricing models. The infrastructure of the dollar is simply too sticky.
Because of that immense friction, what we're seeing right now isn't an overnight revolution. It's a gradual shift. Countries like China and Russia are taking specific, calculated steps. China is pushing yuan-denominated oil contracts and utilizing the gold market to bypass the dollar, which is part of why gold prices have been surging. Meanwhile, Russia is settling select transactions in rubles and reducing its U.S. Treasury holdings. They're strategically reducing dollar use where it's politically necessary, especially under the pressure of sanctions, while still utilizing the dollar when it's convenient and efficient.
Which leaves us with the ultimate million-dollar question to close out our explainer today. As these strategic financial shifts accelerate, and as nations selectively move towards gold and alternative currencies, are we witnessing the slow, gradual unraveling of the 50-year petrodollar system? Is the bedrock of the global economy beginning to fracture? It's a question that's going to define the geopolitics of the next half-century. Keep these dynamics in mind the next time you see headlines about global trade, and you'll understand exactly the game that's being played. Thanks for joining me on this explainer, and keep learning.